Thank you for coming out this morning. Before we begin, I just wanted to advise everyone that this is being recorded and it will be posted to the Foundation's website for future viewing. So my name is Robert Massicotte. I'm with Edward Jones Investments, financial advisor. My office is on South Edgware Road in St. Thomas. And today, it's my pleasure to partner with the St. Thomas Elgin General Hospital Foundation and Mackenzie Investments to provide this session on the charitable giving. This morning, I am pleased to introduce Carol Bezaire as our speaker. Carol is Vice President of Tax, Estate, and Strategic Philanthropy at Mackenzie Investments. In her role, Carol leads a team of 5 tax and estate planning professionals and 1 practice management expert, all of whom support and offer opportunities to help financial advisors like myself stay well informed in an ever-changing marketplace. Carol is also Managing Director of the Mackenzie Corporate Charitable Giving Fund. Carol has been at Mackenzie for 16 years and spent 6 years in a similar capacity at another Canadian mutual fund company. Carol also worked for a number of years as an advisor, providing financial and estate planning advice to high net worth individuals. Carol is a member of the Society of Trust and Estate Practitioners. She has her certified financial planning and chartered life underwriting designations. And Carol is also a member of the Canadian Tax Foundation. Today, Carol will be talking to us about charitable gifts made easy through your financial plan. At the conclusion of Carol's presentation, we will invite you to join in and ask any questions that you may still have about charitable giving, or any other questions that you might have for myself or the panel. So, Carol?
Thank you so much, Rob, and to my colleague Brent, and also to Kenzie for giving me the opportunity to talk today. One of the things that we're finding, just to start out, hope everybody's staying safe and sane these days. It's getting more difficult. But with the pandemic, one of the things we've noticed that it's creating a lot of issues for all of us, but most urgently at our hospitals. Fundraising events in order to support the hospitals are getting more challenging, as Kenzie could tell you. They can't do any fundraising. They have to do virtual fundraising. They can't have a gala dinner. It's very, very difficult to try to keep funding going. And also Canada Revenue Agency has just put out a report saying that donations from Canadians have gone down from 2019 to 2020, which makes more of a challenge. And that's because they're taking care of their own families as well. So this presentation talks about the opportunity for you as donors to look at how you can provide ongoing support to STEGH and other charities of your choice by working with financial advisors like Rob to plan your longer term legacy plan. So this is about building a legacy based on your philanthropic views. Sorry. This is our standard disclaimer. You don't have to read it. It's just my team is here to partner with advisors like Rob and our sales teams like Brent to provide you with education and information so you can make educated choices for your tax, your estate, financial plan, or your legacy plan. So when we look at what is your legacy, just as with anything else like estate planning, this is about you and your signature. So it's a very personal kind of a decision that you would make, but it's basically, how do you want to be remembered after you're gone? What impact do you want to make on the world? And what kind of legacy do you want to leave to your community? Some people want to leave something, some people don't, but you're here today because you're philanthropic. So let's talk about some legacy planning, which means how do you continue to give and support STEGH and the charities of your choice even after you've passed away? And giving is all about choice. The choice whether or not you want to give, the choice of which charity you want to have supported, and the choice of when. What's the best timing for you? There's a number of different reasons that people want to give. And you're here because, for the most part, you believe in STEGH and what they do and all the good work that they're doing at the foundation. There's fundamental choices of how you give. Do you want to provide immediate support? Do you want to provide longer term support? And this is where, for many Canadians, talking to an advisor will help you set the most meaningful goals that you can in your legacy plan. Because we know 82% of Canadians, according to Canada Revenue Agency, do donate to charity, but they don't really plan it. For example, my niece, Audrey, one of her classmates actually at recess went into cardiac arrest. So what the school has done, and they're only in grade 6, what the school has done is created a skip-a-thon. So they're going to take an hour and everybody's going to go skipping to raise money. So I got the link. So of course, she's my niece. I put in $25. And you don't really think about that, but it adds up after a while. So planning ahead to do other things other than, the immediate one like that one does make sense. So let's talk about how you can build your legacy. And then I'm going to talk about how we can help you do that through the Mackenzie Charitable Giving Program and Edward Jones and the good work that Rob does. So when we look at Mackenzie Charitable Giving Program, I'll delve a little deeper into it, but this is not the immediate support, it's longer term support for the charities like STEGH. What you can do with this is have the advantage of your own private foundation account without having to run the whole foundation. No upfront cost to get the registration number through CRA, go to your lawyer and get a corporation or a trust set up. You don't have to worry about the administrative responsibilities either. What we try to do is provide services and programs so that Rob can add value as well. And also part of this is keep it simple, keep it convenient, and allow you as a donor to set up your philanthropic long-term plan now and over time to take care of your charities. So who are we? Well, this is actually the Strategic Charitable Giving Foundation. Mackenzie actually spent the money, about $100,000, to set up a registered charity that is housed within Mackenzie but doesn't belong to Mackenzie. It is a standalone charity. It's been established since 2006. Over $2 million received in donations from clients in over 1,700 accounts. Now, this foundation is licensed to operate in all provinces and territories in Canada. And how that works is because we know that advisors like Rob can add value. It's licensed to trade through Rob, through Edward Jones, or any other dealer or financial advisor in Canada. Why did we set this up? We wanted to provide professional investment management options for donors, which will, over time, instead of money going straight to STEGH in one donation, it's like, let's build it over time so that, a $100,000 donation, for example, being built with professional investment management, as money flows out on a continuing basis to the STEGH Foundation, over time, they're going to get more than 100,000 because of the growth within the account that you can see. It's a very simple account setup. Record keeping and administration is done for you. And it also keeps your charitable giving working with your advisor to make sure that you can see and understand what's going on and you can direct it. So this is called a donor advised fund. Grant making is very flexible, and grant simply means the flow of funds from your foundation account out to the charities of your choice. It allows for legacy planning, estate planning, tax planning, and also allows your foundation account, because you will name it, like Bill and Melinda Gates Foundation, which is probably a bad example right now with everything going on with them. but it allows for donor recognition of your foundation account. When we look at the legacy planning, we have to look at the basic taxation and charity concepts. So with this program or your legacy plan, it's always about making sure this is under the Income Tax Act, a charitable gift, which is a voluntary transfer of property without consideration from a donor to a registered charity. So consideration, or what they also call the advantage rule, would be, let's say you go to a gala dinner for the STEGH Foundation and the ticket costs you $100, but you're getting consideration for that. You're getting a dinner. So quite often you will find, okay, I'm going to get a donation receipt for $65 because the dinner itself costs $35. So that's what an advantage or consideration is. And that's with every charity. But also the tax benefits. Many people don't think about the tax benefits, but in Canada, they're very generous. So you can donate and use your donation tax credit against the tax on up to 75% of your net income in a given year, or up to 100% in the year of death or the year preceding the year of death. And what that can do is save considerable tax, and you're giving to the community instead of to the government. Tax credit savings, depending on the province and the territory, there's federal, there's provincial and territory, between 40 to 50% of the value of your donation. There's also the opportunity in Canada to eliminate capital gains if you're donating publicly listed securities to a public charity. And that compares to the 50% capital gain that would be taxable to you if you sold your holding, like a stock or a mutual fund, and then donated the after-tax cash. So if we're looking at a tax credit, and as an example, I'm using 45%, a donation of $100,000, federal provincial credits on average $45,000, which means that $100,000 that you gave to charity only really cost you $55 because you get the tax savings of the $45. There's also more flexible tax benefits that came out in 2016 because there were too many donation tax credits being left on the table and can't be used if someone who passes away is in a low tax bracket. Like maybe there's only OAS and CPP income, but there was a donation made within the will or on a beneficiary designation. Then at that time, the executor could only use a donation tax credit up to 100% of that income in the year of death and the previous year. As of 2016, now the executor can utilize that donation tax credit within the estate. So let's say there is the principal residence that needs to be sold under the estate. Principal residence exemption to date of death. Any capital gain between date of death and date of selling, there's going to be a capital gain. So that donation tax credit can offset the tax of 100% of that capital gain. And there's also a higher donation credit for high taxpayers. And that was also brought in 2016 at the federal level. So for someone who has a taxable income over $216,500, and this goes up every year, there's a 33% donation tax credit. So it's even higher than that 40% to 50% I mentioned. Let's say, for example, John has taxable income in 2021 of $236,700 after deductions and exemptions, things like that, and he donates $30,000 to charity. So how the tax credit works is the usual 15% credit on the first $200 is there, plus provincial. But then on the difference between his income and that threshold of 216, so on the next 20,000, he gets a donation tax credit of 33%. And then it goes back to the usual federal rate of 29%. So you can see that gets very generous because the government is hoping that the higher taxpayers start making more donations to support the communities and the charities. So the next part is, how do you want to give? And this also is up to you. You can do direct giving, give to STEGH Foundation directly. You can give cash, estate gifts, other vehicles like life insurance policies, publicly listed securities, and you can also donate indirectly. And indirectly, about now we've got about 20% of giving is being done indirectly versus 80% direct giving. And the trend is moving forward in Canada. Indirect giving is very popular in the US. So that trend, because the financial advisor is in the mix, it's better planning. So indirect would be your own private foundation or donor advised funds, which is what the Mackenzie program is. There are community foundations that have these, like the London Foundation, London Community Foundation, or institutional programs like the Mackenzie program. There's Aqueduct, there's Canada Gives, there's a number of institutional programs that are available now. So the simple way of giving, of course, is a gift of cash. Receipt, the donation tax receipt, would be based on the face amount of the gift. Give $100, you get a donation tax receipt for $100. And again, the maximum amount of the contribution you can use a donation tax credit against is up to 75% of your net income. But if you can't use that in 1 year, there's a carryover period. You can use that donation tax credit in any of the following 5 years. So you've got 6 years that you can use your donation tax credit. The other thing is if you've got spouses, common law partners, it doesn't matter which one of you makes the donation. Usually we suggest that the higher taxpayer, you're going to get a bigger bang for your buck if you pool all the donation tax credits and the higher taxpayer uses the donation tax credit. When we look at a gift in kind, publicly traded securities, that would be, again, if you're donating to the STEGH Foundation, they have a trading account. They can take the stock or the mutual fund, and they'll be able to liquidate it. You can do the same thing with a gift to a private foundation, and the gifts of securities all have to be listed on a public exchange. So if you've got private company shares, for example, most charities can't accept them. So the characteristics of public securities is how the donation tax credit gets calculated. So it's based on the fair market value on the day of ownership, when that's transferred to the charity and it's liquidated. So typically the closing price. Now, none of the capital gain is taxable to you. You will get a tax slip. And that's what many people don't understand. You're still going to get what they call a T5008. But then there's another form that you fill out called a T1170 that says how much of the security that I sold did I donate to charity. So it gives you the flexibility of donating some or all of a holding. And that's where you would talk to Rob about exactly how much. And the carryover period is the same 5 years as it would be for a regular gift. Where I had this, one of the clients that I worked with, an advisor, and she was in her late 70s. She had, her portfolio was very, had a lot of capital gains in it. And when we were talking, her husband had passed away some years ago. And the advisor said, not only does she have these frozen portfolio holdings because of the capital gain, she's very philanthropic. So we met with her and we talked about, you know, you can donate part of your holdings so that the donation tax credit generated will offset the tax on the rest of it when you sell it. So we worked that through with her and she went, oh, because she was in her late 70s, it's like, if you pass away tomorrow, here is the tax bill that will go to the government. So we thought about that. And then I said, also, that can be donated if you're interested to your own foundation account in memory of your husband and yourself. And she thought that was great. She said, but I support charities already. I'm writing checks. And I said, well, how many checks do you write in a year? And she says, 23. Okay, we could do that for you and make sure the money flows out to the charities of your choice, even if you pass away. So we ended up opening the account for her. She donated. And then she tied her will, actually, because they had no family, to her foundation account. And the advisor is overseeing for them the 23 checks that go out. Foundation administration does that, but he's watching the investments on their behalf. And that will continue on. She passed away about 5 years ago. 23 checks go out, and the account itself was about $3 million after tax, and the donation credit actually lowered the tax so that the rest of the money that went out to nieces and nephews was higher. So there's different reasons why people want to do this. There's also a gift of life insurance. Two ways that you can do that. So the charity would receive the proceeds of the policy, the death benefit, upon the death of the insured, or you can work it so that maybe it's an upfront benefit where you can donate the ownership of the policy to STEGH, or you can not transfer the ownership, but name the STEGH Foundation as beneficiary on your life insurance policy. If you do transfer the ownership of the policy and you're the insured donor, then the tax benefit and the large future gift would be upon your passing. So the transfer of ownership to the STEGH Foundation, they're going to hold that. You'll get a tax receipt right away for the value of the policy. But again, for any premiums, because you'll keep the policy going, you will get a tax receipt for the premium paid. So I just want to show you quickly how that works. So if you transfer ownership, then let's say there's a $500,000 policy and a $12,000 annual premium. So the premium, $12,000, the tax credit or savings from the contribution would be about $5,400. So the net cost to you when you pay the premium wouldn't be the $12,000 because of the tax savings. It's actually $6,600. And then upon your passing, STEGH Foundation would receive the death benefit of $500,000, and there's no further tax donation receipt. But this starts funding in your foundation account. If you compare that to not transferring, but you name STEGH Foundation as the beneficiary, for example, or your own foundation account, then if there's going to be significant income on the final tax return, it may make more sense to defer the tax benefit to the final 2 years or the estate to minimize tax. Tax credit on the final tax return would be based on the death benefit of the policy itself. Amount of the life insurance on the final tax return would be 100% of income, like a bequest, with the 1 year carryback. But if you name STEGH Foundation as the beneficiary, then in Ontario, there's no probate because it goes directly to a named beneficiary. So the difference between what I showed you before with the transfer of ownership and not transferring would be, okay, the amount of the life insurance benefit would be $500,000 and the tax credit would be $225,000, which carries back to the estate itself and lowers the overall estate taxation. So there you're giving to the community and not to the government again. You can do the same thing, not just life insurance, your RSP, your RIF account, even your tax-free savings account. And I have seen some people actually set up what we call a charity tax-free savings account. They don't want their whole TFSA to go there. So they set up a smaller one and they name their charity directly on there. Because if they pass away with a RSP or a RIF, the donation tax credit can still be used against the income inclusion for the registered plan. Or you can name the charity the beneficiary on any of those plans. Donation tax receipt will go to the estate for the value of the account upon your passing. If there's a withdrawal and subsequent donation, then there's going to be withholding tax with that, especially for an RSP. The donation tax receipt would be for the value of the donation. So just to show you quickly how that works, we have Ida here who passed away and she had an income of $35,000. So not a lot of income, but she also had a RIF which was $155,000, and she named her church as the beneficiary. So her income on her final tax return when she passed away would be $190,000 because that RIF gets added into her income. Tax at death, around 34.9, we figured this out, would be $66,310. So a lot going to the government. Donation tax credit, $62,155. So if we look at that, then the tax payable by Ida's executors for her would drop down to $4,155. So you can see credit in the year of death, it could all be used in the year of death. You don't really have to worry about anything because the donation tax credit offsets the tax at death. When we're looking at the Mackenzie program, as I mentioned, this is a donor advised program, which is a legacy plan. It's meant to be a legacy plan. It's not a mutual fund, although it holds mutual funds, but it's not a mutual fund run by Mackenzie. It's run by the foundation itself. It is the equivalent of a private foundation. It just is much easier for you to see and monitor it. Very simple, cost effective, and it keeps your advisor like Rob in the center of the strategy with you so that you've got the right investments in there and you know how to set your legacy up. You might be interested in this program if you're receiving maybe a large one-time asset transfer, for example, an inheritance. We just spoke with a gentleman who actually won $3 million on Lotto Max. And he decided he doesn't have a lot of family, because I'd like to do something for the community. So what I want to do is I'll set up a foundation account. If you already give to charities, but you want to simplify how that goes and have someone else take care of the headache for you, maybe you're looking for something that's longer term, it's flexible, it's a little more strategic than just writing a check and handing it over. Also, maybe you're you have been thinking about setting up your own private foundation, but you don't want to have to afford the time or the money. A gentleman I work with and his advisor, and he was unfortunately terminally ill. So he was thinking of setting up his private foundation because he had no one in his family. And he had been very, very successful in life. He had about $5 million. He wanted to tie his estate to his foundation. So I sat with his advisor himself and his estate lawyer, and his estate lawyer was thinking about setting up the private foundation. But when we talked to them about the Mackenzie program, he says, this is exactly what we're doing, and I don't have to do all the work. So we set it up, and there was one charity that he wanted to have his name in the program every single year. So we set it up under his name with his foundation account. And when he passed away, the advisor now is running that $5 million for him, and the check goes out every single year under the gentleman's name. You might be a business owner who supports local charities or communities. If you do that through your corporation, the difference between the donation tax credit and how your corporation handles this would be a dollar for dollar deduction before tax. So your corporation donates 100,000, it's 100,000 deduction before tax on your income. And that too is the deduction in that year, or it can be used in any of the next 5 years as well if you can't use a donation in the current year. Or maybe you're just looking for tax or estate planning strategies to align with your philanthropic objectives. So how does the program work? Well, getting started is pretty easy. There's 4 steps. First, you decide you work with Rob to set up the account. I'm interested in doing this. I want to set the account up. And then you make the donation. Review the annual grant amount. How much do you want to have flow out to the STEGH Foundation or any of the charities that you want? You can choose between 4 and 25%. But what you do want to do, if this is your legacy plan, is let it build with good investments. And therefore, you're going to be sending more money over to the charities over time. And then you recommend the grants, meaning which charities do you want to have supported? So let's walk through a quick example. So this is always an irrevocable donation. So an irrevocable donation means although you can see what you've done with your donation, you can't take it back. So Kate makes an irrevocable donation. She puts in $100,000 to start up her foundation account. She decides she's going to name her account the Evans Family Account. You can name it the Evans Family Charity Trust. The only thing you can't use is foundation, because Strategic Charitable Giving Foundation is the foundation. You will have a sub-account of the registered charity. Kate will receive a tax receipt for $100,000. And as mentioned, it can be cash, securities, mutual funds, or life insurance. So the donation goes into the Strategic Charitable Giving Foundation. Then the client of Rob becomes a Strategic Charitable Giving Foundation. And then it's a corporate account. You can see it. You're going to get statements and everything else, but everything belongs to the Strategic Charitable Giving Foundation as the charity. And then you choose the eligible investment. Now there's one per account, but as I mentioned, to keep it simple, these are all our managed programs, managed products. So the diversification in there is handled on your behalf by the portfolio managers. So you don't have to worry about building a big portfolio. We just keep it simple, and your advisor can help you with that. And then once it all set up, then you can recommend the granting rate. How much do I want to go out of my account over to my charity? So Kate can select, as I mentioned, between 4 and 25% in the first 12 months, or 4 to 100% after that. Now, why it might be 100% is maybe Kate decides, you know what, I don't like this program. But usually we find that clients like this, and it's maybe 8%. So you want the money to grow, but you want it to move over. So this year, Kate's fund has $4,000 available to grant. We're assuming that she's chosen the 4%. People can make it vary, but one of the good parts about the Mackenzie Foundation or this program is sometimes with a large donation, smaller foundations or smaller charities can't use all of that, can't take it all in. So that can be a problem, like a small church, something like that. So having it all in one spot and then flowing it out makes it very good for the charities. And, you know, STEGH Foundation, it would go every single year so that that becomes part of their budget, which is great for them to do the planning. And Kate can recommend the grants. It has to be a registered Canadian charity. Minimum grant per charity to make it meaningful is $250. But as you can see here, she's got 4 different charities, different amounts to each one. You tell us, Foundation Administration will do that. The grants come from Strategic Charitable Giving Foundation, the Evans Family Account. So they know that that is the foundation. And then every year she can keep it running the same way, or she can send us in a change of granting form to maybe go to a different foundation in memory of someone, whatever, but it's very flexible. Then after that, she can add to her foundation as part of her tax planning, her legacy planning, working with her advisor. She can tie her will or beneficiary designations to her foundation account. She's going to receive ongoing reporting. And if she passes away or can no longer manage her fund, she is allowed to name a successor on her account. Might be a child. A gentleman that I opened one up for, he didn't have a lot of family. But when I talked about successor, because he tied his estate, he was 92 when his advisor and I spoke to him. And he said, I just want my money and my estate to go to these 2 charities. So he had supported them all his life. So we talked to him about that. And I said, okay, do you want someone to oversee this with the advisor should anything happen to you? And he said, you know what, I think I'll have my nephew do that because he understands what I'm doing with this philanthropy. So that's a way for the advisor to get to know the nephew as well. So name a successor. He passed away about 6 years ago, and his estate was very large. So it's nice to have someone working with the advisor just to keep that conversation going. Set out a standing grant recommendation, like the lady with the 23 checks. We always honor it. Or she can close out her fund if she no longer wants it, or no longer feels she needs it. So you can see how flexible this is. So just to summarize why this program might be attractive to you, because it is simple. It consolidates all of your charitable giving in one account. We'll cut the checks. You just tell us. You are the donor. You are advising us. Cost effective. All the benefits of a private foundation without having to have the administrative responsibilities. You don't have to have a board meeting. You don't have to fill out the tax return. That you don't have to have an audit every year. It also is another reason to work with your advisor in your charitable planning as your overall financial or estate plan. With the 15 funds we have, you get professional asset management, easy record keeping, and tax reporting. You can support the charities you want when you want. You can be acknowledged, have your family name on there. You tell us if you want the thank you letters from the foundation that gets the grant. You can remain anonymous. We have a number of accounts where the client's name isn't even on it. We have one called, for example, on Bended Knee. We have one called the Red Robin Foundation. So this part is up to you, but it is a great way to create a charitable legacy that will live on after you have gone. So how does it work? The program itself, to open an account, the initial donation is a minimum of $10,000. After that, additional donations, $500. You can run a pre-authorized checking plan, $125 quarterly or $500 annually after the first $10,000 goes in. Foundation is Strategic Charitable Giving Foundation, which will issue the donation tax receipts, but you can name your own sub-account. Investment options, very wide range of 15 Mackenzie investment mutual funds or ETFs, but they're balanced in income, which is under the same ruling as the STEGH Foundation would run in order to protect the capital. You can remain anonymous. You've got succession options. There's also the opportunity for third-party donations. So if there's a third party who wants to donate to the Evans family account, they can do that. And then you give foundation administration the information on the donor and they get the donation tax receipt. And that happens quite often. I have a gentleman whose son died in Afghanistan. So when there's no pandemic, he has a golf tournament. And what people do is they will donate in order to play, but they get a donation tax receipt net of the cost of the golf. So they can do that, and there's about 30 people who donate, and each one gets their own tax receipt. And then the cost. We're saying this is low cost. We drop the cost from 1% of the value of your account per year down to 55% or 55 basis points. As your account gets larger, we move that down as well, because this is for charity. We want to make sure that the administration costs stay down. And administration costs are just for cutting the checks, writing the letters, doing all the paperwork on your behalf. So I'm going to stop there. I want to thank you very much for being here today, and I will turn it back to Rob for any questions. Thanks, Rob.
Thank you very much, Carol. So, thank you, Carol. So, Kenzie, if there's any questions, do they just unmute themselves, or I think
yeah, so if anyone has any questions at this point in time, please feel free to unmute yourself or even text it or type it in the chat box.
I do have a quick question. Carol, I was just curious, you had mentioned about being able to do your RIF and your TFSA. If somebody wanted to start one of these by contributing the $10,000 from their RSP, are they able to just donate the RSP so that it doesn't count as income that year, but you get the tax credit for it? Or is that not set up so that, because you could cash out 10,000 from the RSP, and then that would be income. Obviously, you'd get a T4 RSP, but is there a way around that by donating the RSP to the foundation?
No, they would have to collapse it because the RSP can only be owned by the annuitant themselves, like the Canadian taxpayer. But we have found that if you want to do that with the RSP, we have now found that if we utilize the T1213, which will reduce withholding tax at source. If it's going to charity, then if it's 100,000 coming out of the RSP direct to charity, there's no withholding tax. So the whole 100,000 can go to the charity. There's still going to be the income inclusion, but then you've got the donation tax receipt.
Oh, okay, good. Well, no withholding tax. Nice.
Yeah.
Do we have any further questions? Kenzie, we're okay to move forward then? Carol, thank you so much for taking time today to be with the foundation and taking part in our legacy series this morning. We really appreciate the fact that you were able to include STEGH Foundation as well as Robert within your presentation. That certainly means a lot to us.
My pleasure.
We hope that attendees will complete a follow-up survey, which will be emailed. And we would like to remind everyone that a recording of today's session will be posted to the Foundation's website. Takeaway materials are available on our website or available through Robert's office. We also hope you will plan to join us next week when Robert Massicotte and Sun Life co-sponsor guest presenters Laurie Clements and Gordon Hawking speaking on Grow and Protect Your Legacy. For those who are interested in learning more about financial planning or thinking about a future gift in their estate plan for our hospital, please contact Robert or myself. Thank you, everyone, and have a great day.
Thank you.
Thank you.
Thank you very much. It was very informative.
Great. Thank you.
Glad to have you with us.
Thank you. Very good session.
Thank you. We appreciate